In this explainer, we're going to pull back the curtain on that surprising link between the U.S. central bank, the Fed, and how money flows into economies all over the world, like India.
Okay, to really wrap your head around this, I want you to imagine something. Picture the entire global economy running on water that comes from one single massive plumbing system. Now, what happens when just one entity gets to control the main valve, deciding how much water flows, where it goes, and how fast? Well, that water is the U.S. dollar, and that entity is the U.S. Federal Reserve.
All right, so first things first, before we can get into the pipes and the valves and all that, we have to understand the water itself. We need to talk about the U.S. dollar and exactly why it rules the world stage.
So you'll hear this term reserve currency. What does that even mean? Well, the U.S. dollar is the world's #1 reserve currency. It's basically the default money for the planet. If a company in Japan wants to sell cars to Brazil, chances are that whole deal is going to be priced in dollars. And this isn't an accident. This global trust is built on the fact that U.S. financial markets are seen as incredibly deep and stable.
Okay, so if the dollar is the water, how in the world does it get everywhere? Well, it flows through this huge, complex network that you can think of as a global dollar plumbing system. And sitting right at the controls at the main pump station is the U.S. Federal Reserve. And this whole system really relies on 4 main pipes. First up, you've got trade. Like we said, most stuff bought and sold internationally is priced in dollars. Second, there's bank reserves. Central banks all over the world just hoard dollars as a safe asset. Third is investor capital. I'm talking about trillions of dollars from investors buying and selling U.S. stocks and bonds. And finally, you have the actual payment pipes, huge systems like SWIFT that clear all these dollar transactions. You put all that together, and it creates this constant, massive demand for U.S. dollars. So we've got the water, and we've got the pipes. Now for the really crucial part, how does the Fed, the operator of this whole thing, actually control the flow? How does it turn that valve? It all boils down to one main tool: interest rates. It works like this. When the Fed eases, meaning it cuts interest rates, it suddenly becomes super cheap to borrow dollars. So what happens? All that capital floods out of the U.S. and into emerging markets like India, searching for better profits. But when the Fed tightens, when it raises rates, the opposite happens. Borrowing dollars gets expensive, and U.S. investments suddenly look a lot safer and more attractive. That money comes rushing back to the U.S., which makes the dollar stronger. It's like a giant global seesaw, and the Fed is sitting right in the middle, shifting the weight.
But wait, what happens in a real crisis? When the whole system freezes up and those dollar pipes get clogged. Well, the Fed has a powerful emergency tool for that. They're called swap lines. Think of them as special emergency reservoirs of dollars. The Fed can open these lines and flood a select group of friendly central banks with dollars to stop a global financial panic. It's a huge deal for keeping the entire system stable.
So that's the big picture system. Now let's get concrete. Let's zoom in and trace these dollar flows to see exactly how they hit a country like India. And the effect on India is, well, it's direct and it's dramatic. You can see it right here. When the Fed is in easing mode with low rates, foreign investment just surges into India. Investors are chasing those higher returns. But the moment the Fed starts to tighten, that flow can slow to a trickle, or it can even reverse, as all that capital gets sucked back to the safety of U.S. assets. And this puts India's own central bank, the RBI, in a really, really tough spot. This quote pretty much nails the constant debate they face. Do they follow the Fed and raise their own interest rates to stop money from leaving, even if their own economy doesn't really need it? Or do they try to decouple and set their own path, but risk a massive outflow of cash? It is a constant, high-stakes balancing act. So, what's India's main line of defense against all this chaos? Well, it's built its own massive reservoir. India holds one of the biggest stockpiles of foreign currencies in the world, mostly U.S. dollars. This is their buffer, their war chest that they can use to try and stabilize their own currency when these huge capital flows start rocking the boat. But here's the catch. Remember those emergency swap lines from the Fed? India doesn't have one. Now, they have other arrangements, for sure, but they don't have that direct emergency pipeline to the Fed's pump. And that raises a pretty critical question. If a really big global crisis hits, is India's own buffer truly enough to handle it. This whole dollar-dominated system has been the bedrock of the global economy for decades now. But is it permanent? Or are we starting to see a few cracks appear in those pipes? Now look, the US dollar is still king. There's no question. It makes up almost 60% of all the reserves held by central banks. But if you look closely, you can start to see these small but noticeable shifts happening. Central banks are slowly, carefully diversifying. They're adding a bit more euro, a little more gold, other currencies like the yen or the yuan. It's not a revolution, not by a long shot. It's more like a slow, quiet evolution. So the bottom line is this. The dollar's plumbing system is still incredibly powerful. It continues to shape the economic fate of countries all around the globe. But the question we have to ask is, for how much longer? Are these small shifts we're seeing just noise? Or are they the very first signs that new pipes are being laid for a totally different multi-currency world? That right there is the trillion-dollar question for the 21st century.